Farfetch, once hailed as a beacon of innovation in the luxury fashion industry, finds itself engulfed in a storm of troubles that threaten its very existence. The recent departure of major luxury brands, including those under the Kering Group umbrella, like Gucci, Balenciaga, and Bottega Veneta, signifies a seismic shift in the industry landscape. But why is Farfetch sold? And which challenges did the company face before Coupang bought the company for $500 million? Before we dive into the history of Farfetch, we want to tell you more about Coupang, the South Korean company that paid $500 million for a company which is facing great challenges. So why did Coupang buy Farfetch? Coupang is an e-commerce company that operates primarily in the retail sector. It is known for its online marketplace platform, where customers can purchase a wide range of products, including electronics, household goods, fashion items, groceries, and more. Coupang's business model revolves around providing customers with a convenient and efficient shopping experience, offering fast delivery options and a diverse selection of products. In addition to its e-commerce platform, Coupang also operates various other services such as Coupang Eats, Coupang Play, and Coupang Rocket Fresh. Coupang's success can be attributed to its relentless focus on innovation, customer satisfaction, and strategic expansion. As it continues to disrupt the e-commerce landscape, Coupang remains a powerhouse in the retail industry, poised for even greater achievements in the years to come. Coupang's acquisition of Farfetch, a luxury e-commerce platform for $500 million, was a strategic move aimed at leveraging Farfetch's established presence in the luxury market to further strengthen Coupang's position in South Korea. This is Millennial Money Minds. Today, we discuss the $500 million selling of Farfetch, the online luxury fashion powerhouse. Before we continue on the challenges the company faced the last years and why Coupang bought the company, we go back to 2008, the year Jos Neves launched the powerhouse. Jos Neves, a visionary entrepreneur, embarked on a journey that would redefine luxury fashion as we know it. With just a team of 5 dedicated individuals, Jos pressed the button to launch Farfetch.com on October 9, 2008, marking the beginning of an incredible odyssey. As the years unfolded, Farfetch evolved from a humble startup to a global powerhouse in luxury fashion. The journey was not without its challenges, but as Bill Gates once said, most people overestimate what they can do in 1 year and underestimate what they can do in 10 years. Farfetch proved this adage true, as it soared to a market capitalization of approximately $8 billion on its first day of trading. The business model was revolutionary, blending technology with luxury retail in a way that had never been done before. Farfetch pioneered a new retail model, akin to a digital Selfridges, offering a vast array of fashion products without the burden of owning inventory. This innovative approach attracted investors and customers alike, propelling Farfetch to the forefront of the industry. As Farfetch continued to flourish, it attracted attention from investors around the world. From European venture capitalists to strategic partners like Chanel, Farfetch's journey was fueled by significant access to capital and a relentless pursuit of its vision. Through it all, Farfetch remained committed to its values and culture, recognizing the importance of aligning its team towards a common goal. This dedication to authenticity and integrity laid the foundation for future growth and success. As the years passed, Farfetch's reach extended across continents, connecting fashion lovers from London to Tokyo and beyond. Each gathering, each partnership, each milestone was a testament to the company's unwavering commitment to its mission. However, the roots of Farfetch's demise can be traced back several years. Despite its promising start as an innovative marketplace platform for luxury brands, Farfetch began facing financial troubles post-IPO. The company's spending soared, with reports indicating that it burned through at least $1 billion in cash since its listing. Concerns over rising costs prompted investors like Condé Nast to divest their stakes in the company. Moreover, Farfetch's expansion into various business ventures deviated from its core model, leading to investor skepticism. Its marketplace heavily relied on discounts to attract customers, while its platform solutions business lacked momentum. Additionally, own brands such as Off-White and Palm Angels began losing market share. Although these warning signs were evident, Farfetch benefited from the e-commerce boom spurred by the COVID-19 pandemic. The surge in online shopping during lockdowns provided a lifeline for the company, helping it achieve profitability for the first time in 2021. However, this success was short-lived, and the underlying financial issues continued to plague Farfetch. Furthermore, the departure of Neiman Marcus Group, despite Farfetch's substantial equity investment, underscores broader concerns about the viability of its partnerships. The decision to end commercial ties, including the Bergdorf-Goodman replatforming project, highlights a loss of confidence among key stakeholders. Despite mounting concerns, Farfetch enjoyed favorable media coverage and support from industry analysts, creating a narrative of optimism surrounding the company's future. Influential publications like Business of Fashion touted Farfetch as the future of luxury retail, while analysts praised its disruptive potential in the market. However, as the financial pressures mounted and Farfetch struggled to deliver on its promises, the narrative began to unravel. Analysts, once bullish on Farfetch, started questioning its viability, highlighting its unsustainable cash burn rate and divergent business strategies. Ultimately, the hype surrounding Farfetch proved to be short-lived, giving way to the harsh reality of its financial troubles and eventual acquisition by Coupang, Inc. With a strategic focus on expansion and innovation, Coupang has captured the attention of analysts and investors alike. Analysts project a continued upward trajectory for the company, with sales expected to rise by 17% to $24.8 billion for 2023 and by 13.3% to $27.27 billion for the full year 2024. Additionally, adjusted earnings per share are forecasted to increase to 0.44 for 2024, compared to 0.25 expected for 2023. Coupang's global footprint is extensive, with offices spanning across major cities such as Seoul, Shanghai, Beijing, Shenzhen, Hong Kong, Mountain View, Seattle, Riverside, Taipei, Bengaluru, and Singapore. With a workforce of 63,000 employees, as of December 31, 2022, Coupang operates on a vast scale, bringing together diverse talents from around the world. Notable investors like Bill Gates have recognized the potential of Coupang, with Gates acquiring 9.25 million shares between 2021 and 2022. His position in Coupang, currently valued at $133 million, reflects his confidence in the company's growth prospects. With Farfetch struggling, Coupang saw an opportunity to tap into the booming luxury market in South Korea and establish itself as a go-to e-commerce platform. Despite Farfetch's recent setbacks, it still boasted a considerable customer base of 4 million users, making it an attractive asset for Coupang. Coupang's focus on the South Korean market was evident in its acquisition strategy, with analysts noting that the acquisition was more about strengthening Coupang's platform locally rather than expanding into Western markets. While some Asian e-commerce platforms have ventured into Western markets, Coupang's acquisition of Farfetch seemed geared towards enhancing its presence in South Korea rather than making a push into U.S. and European markets. Overall, the acquisition of Farfetch provided Coupang with an opportunity to establish itself in the luxury market segment and capitalize on the growing demand for luxury goods in South Korea. On February 15, 2024, Farfetch founder and CEO Jose Neves shook the industry by stepping down, sending shockwaves through the luxury marketplace. And he's not alone in this exodus. According to reports from the business of fashion, top-level executives, including the CFO, COO, Chief Product Officer, and Chief Platform Officer, are also bidding farewell. But why the mass exodus? Well, luxury powerhouse Kering is pulling its prestigious brands, like Gucci and Yves Saint Laurent, from the Farfetch platform. And it doesn't stop there. Neiman Marcus Group is backing out of a deal that would have seen Farfetch managing the Bergdorf Goodman website and app. These moves follow Farfetch's controversial sale to South Korean e-commerce giant Coupang, completed on January 31, 2024. After months of uncertainty, Farfetch found a lifeline in Coupang, securing $500 million in capital to keep operations afloat. But not everyone was on board. The 2027 ad hoc group fought tooth and nail to stop the sale, fearing its repercussions. And now, with Kering and Neiman Marcus jumping ship, their concerns seemed justified. Duplex made it clear Farfetch is no longer a strategic partner for Kering. However, Kering brands may still be available through third-party retailers on the platform. As for Neiman Marcus Group, their $200 million deal with Farfetch is off the table. But Farfetch remains a minority investor, while NMG focuses on building its own e-commerce empire. Despite the setbacks, Farfetch remains committed to delivering an unparalleled online luxury experience. That's all for today, everyone. Thanks for watching. See you on the next episode of Millennial Money Minds.